Okay. Now, let's move on from there. And I talk about the myth of double taxation in chapter 2. It is technically a double tax, right? And there's three ways you could have double tax. The first is that you, right, let's make it $1 million. Have $1 million of profit, and then you pay out, say, $400,000. Well, in Ohio, maybe less, but let's say it's a state that has income tax or franchise tax, so you pay out $400,000. You're left with $6,000, and then you pay that $600,000 out, and you pay tax again. Now, that'd be dividends. They get a special rate, presumably, but we pay tax again, and in Ohio, that'd be about 20%. So we're left with what? 4.8, right? Now, in that scenario, that's a lot of double tax. That's a 52% rate. Does this happen? I hope not. I've seen it. We pick up clients and we see that they are paying at the top rate as a C Corp and then making distributions. And it's like, okay, where's your advisors here? But at any rate, no, we don't voluntarily do this. If we had a company that was continually making $1 million, at least prior years, we're going to get to new law and changing law, we would likely be an S corporation, okay? So we wouldn't even be in this situation. We wouldn't be paying this, and furthermore, if we wanted to distribute, what would we do? We'd pay it out on a wage, right? A wage is deductible. So you just don't run into this. In fact, at lower levels of income, let's say the first 50, the tax in Ohio with no franchise tax would be $7,500, right? And we'd take $42,500 that we were going to distribute, and we would pay 20%, 15% federal capital gains rate, net 5 Ohio, okay? Just round numbers. And so we paid 20%, so that 8,500, right? Okay. So our total is 16,000, which is 32%. So we pay double tax, and it's only 32%. We may be at a maximum rate of 40% combined federal and state. So we actually, the second method of taxation is 2 layers of tax, even today, currently, can be lower than 1 rate of tax. It's like, why would you do, even if you're taking it all out, if you're at 50 or below, if you're at these higher rates individually, some people don't get this stuff. But anyway, it's lower today. Now, most of the time, I mean, this is a limited opportunity to only up to $50,000 of income, and then again, they have to be at the higher individual rates. So it doesn't apply, a lot, but it applies, and we do this. But most of the time, it's that we pay the tax here at the corporate level, and then our second tax, if we ever have it, is down the road, and hopefully at preferential capital gains rates. Now, we're looking, we think, at a 20% capital gain rate going forward. That's what we're assuming. And then maybe another 5% state of Ohio. And so that would take this up to 37. But this might also go up to 45, right? So we have our same differential. So the first myth is that, okay, yeah, it's double taxed, but 2 low taxes is better than 1 high one, right? And even if the double tax is a little higher, let's say it was more like the double tax ended up at 40 because we're at the higher C rates, and the individual tax today is only 35. Well, if we were paying that all today, then we're talking apples and apples, and we lose 5%, okay? But if we're paying this one today as opposed to, say, half of that today and half in 10, 20, 30 years, that's way in the future. If it's paid 10 years in the future, it's probably only costing us in today's dollars 10. So we're further ahead. So even if they add up to more, they still, with time value money, it could be better off. And then the whole idea, even if it ends up being 35 or 40, and it is more present value, okay? Maybe, just maybe, it's more important to have the company grow and expand and have money to reinvest back in the company currently, even if it costs us some down the road. So it's kind of like, the only reason I say that is that, one is that it should be pretty low in the choice of entity thing, but two is we don't know what's going to happen generally. So why be so worried about something that may never happen? And even if it does happen, it's probably not going to be much worse off unless we're at real high levels of income and all that. So this first myth of double taxation is that we don't voluntarily pay double tax unless maybe we're in this situation. The second one is 2 low rates is less than 1 high rate, especially after considering time value money. And then the third one is this idea that we're going to have double tax on a sale, okay? Maybe, maybe not. I've helped with tax planning with literally thousands of transactions. Sometimes that's just a 15-minute call, and sometimes that's a full-blown ordeal that takes a lot of time. But I mean, it's definitely over thousands, probably over 2,000, a bunch. And except a couple situations where I believe mistakes were made, either in the planning or in the execution of the sale, and we came in afterwards. So 5 or less was there significant double tax. I mean, that's it. And if we would have planned properly, those should have never happened. When I say we, I mean all the way back. Like 2 of them should have elected us way, way back when the business owners became inactive, okay? When they went to Florida, it should have done it. One of them, the attorney, the guy was about ready to die, C Corporation, he wants to get everything all cleaned up, so he sells the assets and liquidates the company. Well, all we had to do, the guy was terminally ill. I mean, I don't want to be morbid or anything, but I'm not an undertaker, but it's like all we had to do is wait till he died, which did happen like a month later, and we would have got step up in basis and only had 1 layer of tax. So I mean, that was just kind of like stupid. And the other 2, I can't remember the facts, but it's very few if you plan properly. And we'll talk about that in a little bit and cover a couple more things.